Welcome to J.K. Michael's Knowledge Series. This is the Career Improvement Series. Today we'll focus on Personal Financial Management sub-series, and our topic will center on how to manage fixed income investments. There are a lot of investments that do not bring in fixed income. The purchase of shares in a business, for instance, provides an income that varies with the changes in the business environment. However, there are investments that are tailored to provide fixed income over a period of time. These kinds of investments would be the focus of this video. Fixed income investment refers to any kind of investment security that pays the investors a fixed return, either by interest payments or dividend payments until its maturity date. At the maturity date, the investors will be repaid the initial amount they had invested. Fixed income is an investment approach focused on the preservation of capital and income. It typically includes investments like government and corporate bonds, certificates of deposit, and money market funds. Fixed income can offer a steady stream of income with less risk than stocks. Fixed income securities are debt instruments that pay fixed amount of interest in the form of coupon payments to investors. The interest payments are typically made semi-annually, while the principal invested returns to the investor at maturity. Bonds are the most common form of fixed income securities. The term fixed refers both to the amount and the schedule of obligatory payments. Now let's see a few examples. If companies issue a 5% bond with a $1,000 face or per value that is said to be matured in 5 years, and as an investor you buy the bond for $1,000 and will not be paid back until the end of the 5-year maturity date. Through the period of the contract, the company will be expected to pay interest based on the rate of 5% per year, and these are called coupon payments. Who needs fixed income investments? Fixed income investments are strongly recommended for investors who want to diversify their investment portfolio. The percentage of portfolio dedicated to fixed income will depend on the investor's style and personality. They remit a stated amount of interest annually in payments every 6 months. They are called fixed income. Fixed income remits a stated amount of interest annually in payments every 6 months if semi-annual. They are called fixed income because they give a reliable flow of income to the investor. Types of fixed income investment products include: number 1, corporate bond. A corporate bond is a type of debt security that is issued by a firm and sold to investors. The company gets the capital it needs, and in return, the investor is paid a pre-established number of interest payments at either a fixed or variable interest rate. When the bond expires or reaches maturity, the payment ceases and the original investment is returned. The high-yield bonds. High-yield bonds are also called junk bonds. These are bonds that pay higher interest rates because they have lower credit rating than the investment-grade bonds. High-yield bonds are more likely to default, so they pay a higher yield than investment-grade bonds to compensate the investors. Municipal bonds. The term municipal bond refers to a type of debt security issued by local, county, and state governments. They are commonly offered to pay for capital expenditure, including the construction of highways, bridges, or schools. Municipal bonds act like loans, with the bondholders becoming creditors. Certificates of deposits, CD. A certificate of deposit, otherwise known as CD, is a savings product that earns interest on a lump sum for a fixed period of time. CDs will differ from savings account because the money must remain untouched for the entirety of your term, or you risk penalty fees or lost interest. CDs have a higher interest rate than savings accounts as an incentive for lost liquidity. Mutual funds. A mutual fund is a company that pulls money from many investors and invests the money in securities such as bonds, stocks, and short-term debt. The combined holdings of the mutual fund are known as its portfolio. Investors buy shares in mutual funds, and each share represents an investor's part ownership in the fund and the income that it generates. The mutual fund is a financial vehicle that pools assets from shareholders to invest in securities like bonds, stocks, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. Treasury bills. A treasury bill is also known as T-bill and is a short-term U.S. government debt obligation backed by the Treasury Department with a maturity of 1 year or less. Treasury bills are sold in denominations of 1,000 US US dollars. However, some can reach a maximum denomination of 5 million in non-competitive bids. These securities are widely regarded as low risk and secure investments. And then we have Treasury inflation protected security. Now these will include Treasury Bonds, Treasury Bills, and Treasury Notes. They are all government issued fixed income securities that are deemed safe and secure. T-bonds mature in 20 or 30 years and offer the highest interest payment biannually. T-notes mature anywhere between 2 to 5 years with biannual interest payments but yields lower. T-bills have the shortest maturity time between 4 weeks to 1 year. And these investments are auctioned off regularly on the US Treasury website, Treasury Direct. The benefits of fixed income investing includes: number 1, diversification of investment portfolio to optimize stock market risk. It's generally accepted that fixed income carries less risk than equities. Fixed income investments are considered to be less vulnerable to macroeconomic risks like economic downturns and geopolitical crises. Apportioning a section of your investment to fixed income will protect you from losses due to stock market uncertainties. Number 2, consistent flow of income. Fixed income investments offer a consistent and a stable source of financial inflows. Bondholders, for instance, receive a fixed amount of interest at nominated periods on their bond holdings, and in the case of municipal bonds, the income is tax-free. Number 3, options to scale up returns. Some fixed income investments, such as the high-yield bonds or junk bonds, offer investors the opportunity to pursue higher returns in exchange for more risk. It is advisable in these situations to understand the nature of the risk to properly manage them. Interest risk may cause the bonds to lose value. When the interest rates rise and the bonds prices fall, bonds offer fixed value at regular periods, and this makes them more prone to inflation risks. If the rate of inflation exceeds the fixed rate of return, then the investment will lose value. It is also possible that the issuer of the security, such as the corporate bond, defaults on the obligation. Thus, the investor might not receive the full value of their principal payment, and this is known as a business risk or financial risk. Ultimately, there will be liquidity risk, which is the possibility that an investor might not be able to sell off a fixed income asset when he or she needs to. And then finally, the preservation of capital. One of the best advantages of fixed income investment is the repayment of the principal upon the completion of the tenure of the investment. Investors often choose to protect the total worth of their investment by ensuring that the investments come with a stated objective of returning the principal. This is known as capital preservation. When investors focus on fixed income investments for regular fixed income and less risk, it is also important to balance these pros with the cons or risks stated earlier. An excellent example would be the ever-present inflation risk, which may reduce the value of investments over time. To summarize, fixed income refers to any kind of investment security that pays the investors a fixed return either by interest payment or dividend payments until its maturity date. At maturity date, the investors will be repaid the initial amounts they had invested. Fixed income is an investment approach focused on the preservation of capital and income. It typically includes investments like government and corporate bonds, certificates of deposits, and money market funds. Fixed income can offer a steady stream of income with less risk than stock. Types of fixed income investments will include: number 1, bonds, which will include corporate bonds, high yield bonds, and municipal bonds. Number 2, certificates of deposits. Number 3, mutual funds. Number 4, Treasury Bills. Number 5, Treasury Notes. Number 6, Treasury Bonds. And of course, number 7, Treasury inflation protected security. Benefits of fixed income investments include: number 1, diversification of investment portfolio. Number 2, consistent flow of income. Number 3, options to scale up returns. And number 4, preservation of capital. For more information on personal financial management, please check out our website at www.jkmichaelspm.com. We have an endless stream of trainings, courses, and materials to enhance your development. If you haven't yet subscribed to our videos, please like and subscribe by hitting the red button with subscribe on it down below. Now for my question. Assuming you wanted to invest in a fixed income investment based on our discussion today, what would be your instrument of choice? Also, Give us reasons for your answers. Please enter your responses in the comment section. We will go through your comments and respond or offer feedback as required. Thank you for watching this video. See you in the next video.